When we're looking at all of these break-even formulas, we're assuming that the price that we're selling a unit of good or service for is known, and that the cost to us, the variable cost per unit, is also known. But we know that prices fluctuate, whether it's the price we're selling something for or the price that we're buying it at. So we know that the point of going into business isn't to break even. And in breaking even, any change in the price that we're selling it for or the variable cost it costs us to produce one unit could mean the difference between profit or loss. So we need to be sensitive to changes in prices. So, for instance, if you're in the airline industry, you follow the price of fuel very closely. Certainly, there's a great deal of risk with the airline industry. Any type of accidents could curtail how often the public flies. Different weather systems may disrupt your operations, causing material impact on your ability to make money off of flights already sold. So, in totality, although you might know your break even point, it could vary from day to day, and you need to take this into account. So, rather than come up with a break even point, we're going to look now at creating a break even band. So, if there's a change in the price that we're charging or a change in the cost it costs us to sell a particular unit, we'll know the point at which we have room in either direction. So we call that break-even band a margin of safety. The margin of safety lets us know how far above the break-even point we are so that we know what type of impact a drop in sales, for instance, might have. So for the example, your break-even volume is we're selling 200 units and we're currently selling 500 units. The margin of safety is 300. That is, we're selling 300 units more than the break-even point. Looking at that in terms of sales dollars, we're going to assume that the break-even sales dollar amount for the company is $200,000, but we're currently doing $500,000 in revenue. So same formula as when we're looking at units. We take the revenues of $500,000 minus $200,000, which is our break-even point. So our margin of safety is $300,000. You can also look at that as a percentage. That would just be the margin of safety divided by the revenues. So $300,000 divided by $500,000. That's 60% margin of safety we have. So if for some reason our revenues were to decline $100,000, we would still be profitable. Margin of safety lets a manager quickly figure out how close to break even they are and if any change in price is material to profitability or loss. So we call a margin of safety a measure of risk. This picture illustrates the concept of margin of safety pretty nicely. On the left, we have our units being sold. On the right, the units at break even. The difference between the units at break even and the units sold is the margin of safety, as we saw before using our formulas. The other measure of risk we'll talk about is operating leverage. When you hear about a company being leveraged, it's usually in terms of how much debt they have as compared to equity. A company that's highly leveraged has a lot of debt. In this context, we're talking about how the company's leveraging their fixed operating costs to generate more revenue. So in the context of a factory, how many more units can that factory produce before you have to add another factory? Is the company operating to its full potential based on the current footprint it has? The degree of operating leverage is measured by taking the total contribution margin and dividing it by the operating income. You'll remember the contribution margin is sales minus your variable expenses, and then the operating income takes into account the contribution margin subtracting the fixed expenses. So this ratio basically shows us how effectively we're utilizing the total fixed costs of the business to generate income. If our operating leverage is high, so that would be if the contribution margin and operating income were relatively close in range to each other, any percent profit increase with sales increase would be large, and any percent loss would be large. If our operating leverage is low, that is that there's a big gap between what our contribution margin is and our operating income. Any changes would be relatively small then. Okay, to wrap up, let's do the example. We'll go back to Whittier. In their lawnmower sales, they plan to sell 1,000 lawnmowers at $400 a piece. Each lawnmower costs them a variable cost of $325. The total fixed costs for the entire business are $45,000 for the year. We know that when Whittier sells 600 lawnmowers, they'll break even. So we want to calculate the margin of safety for Whittier in terms of the number of units and also in terms of sales revenue. So for the first question, calculating the margin of safety in units, we remember our formula for the margin of safety is sales minus the break-even units. We sold 1,000 units. 600 was the break-even. 1,000 minus 600 is 400 units margin of safety. Second question asks us to calculate margin of safety in sales revenue. Pretty similar formula there. The margin of safety equals sales minus break-even sales. We sold 1,000 lawnmowers at $400 a piece. That's $400,000. Our break-even was 600 units at $400 a piece. That's $240,000. 400,000 minus 240,000 is $160,000, which is our margin of safety in sales revenue for Whittier.